So we're gonna go through each of these, and since we're on interest rates, we'll go ahead and talk about those. The interest rate that just happened here a couple weeks ago was a 0.5% interest rate increase, and there was a bunch of stuff in the news about that because that's the highest interest rate hike that we've seen since the year 2000. Well, to put that in perspective, in the year 2000, when interest rates were raised a 0.5 point, they were at 6% already. And they're almost at 0 right now. So they were raised from 6% to 6.5%. That's a lot bigger deal than going from almost 0 to now. I think throughout this year, it's almost 1%, but it was at about 0.5% before this latest interest rate increase. And also for some more perspective, the Fed projected that their median estimate for what they want interest rates to be for this year, I believe, is 1.9%. Still super low historically. And then the next 2 years, they said that their median interest rate goal is 2.8%. So they're not trying to historically raise interest rates back up to, you know, something as high as 6%. And for a little bit more perspective, when inflation was at its very highest in the late 70s and early 80s, the federal funds rate, the interest rate that they were using at one point was 20%. And we're looking at, you know, still at the most 3%. Right. And so something like that is not going to hurt the stock market. And historically, interest rate hike periods have not hurt the stock market either. And so let me show you this graph that we have here of the history of the S&P 500 during interest rate hike cycles. So the averaged annualized rate of return for the S&P 500 during interest rate hike cycles is 9.4%. That's really good. So historically, raising interest rates has not harmed the stock market.